Welcome back to our YouTube channel, your go-to destination for holistic growth. Today, we will try and decode the secrets of financial stability, even in the face of economic storms. Today, we're diving into a crucial topic, how to recession-proof your investment portfolio. Friends, just because we are talking about making your portfolio recession-proof, we do not mean to convey that recession is coming. We just want to equip you with the knowledge on what you should do to stay prepared and thrive in any kind of economic environment. As financial markets always tend to move in cycles of expansion and recession, it becomes all the more crucial that investors stay prepared for any economic scenario and safeguard their investment portfolio. It's wise to always stay prepared for the downturn because during upturns, most sectors and portfolios anyways go up. So let's discuss the strategies and assets that thrive even when the economy goes into a downturn. Recession Resilient Investments, understanding the economic climate. Before we jump into how to shield your investments, let's set the stage. In brief, recessions are characterized by a significant decline in economic activity across the economy, lasting a couple of quarters or more. This negatively impacts jobs, spending, and of course investment portfolios. But here's the silver lining. Not all kind of investments suffer during recessionary times. Some kind of investments are more like economic lifeboats, designed to keep your portfolio afloat. Let's find out how. Historically, recession-resilient sectors. First up, let's talk sectors. Not all industries are hit equally during a recession. Essentials like consumer staples, healthcare, and utilities tend to perform well even during recessions. Why? Because no matter the state of the economy, people still need food, medical care, and electricity. When the economy is going down, if you can make sure that the negative impact is minimized, it becomes all the more easier to recover and bounce back when the cycle turns and economy starts expanding and growing. Hence, consider investing some part of your portfolio in companies that offer everyday goods and services. These companies often maintain steady demand and can offer steady growth and dividends that add a layer of income stability to your portfolio. Safe haven assets. Next, let's shift our focus to safe haven assets. When the stock market becomes a roller coaster, investors often turn to safer options like government bonds and precious metals. Gold, for instance, is not just about the glitter. It's a historically proven crisis asset, often increasing in value when overall stock markets are facing a decline. Consider allocating a portion of your portfolio to gold or other precious metals. They can act as a hedge against inflation and currency devaluation. Diversification and defensive stocks. Diversification isn't just a buzzword, it's your investment safety shield. Spreading your investments across various assets including stocks, bonds, real estate, and international opportunities can help reduce risk. And within your stock portfolio, consider defensive stocks. What are defensive stocks? Defensive stocks are tied to companies that provide services necessary for daily life. Think utilities, healthcare, and consumer goods. Defensive stocks represent a sanctuary for investors, especially during economic downturns or market turbulence, and tend to remain stable when other sectors falter due to economic pressures. This stability makes them an essential component of a well-rounded investment portfolio. Key defensive sectors are FMCG, pharmaceuticals, healthcare, power utility, and telecommunications, etc. Review your asset allocation regularly to ensure it is well balanced as per your risk appetite and aligns with the current economic landscape. The role of real estate and infrastructure investments. Real estate and infrastructure investments can also serve as recession buffers. Rental properties can provide continuous income streams even in tough economic times. These asset classes offer unique characteristics such as tangible value, steady yield generation, and a hedge against inflation, which can stabilize and diversify an investment portfolio when other markets may be faltering. Infrastructure investments often involve assets that provide essential services such as water, electricity, telecommunications, and transport. These services are crucial for the functioning of society and the economy, regardless of the economic climate. As such, the demand for these services remains relatively stable, protecting investments from the worst effects of economic downturns. Infrastructure projects also frequently benefit from government backing, either through direct funding or favorable regulatory environments. For individual investors, direct investment in real estate or large infrastructure projects is often beyond reach. However, real estate investment trusts, REITs, and infrastructure funds provide accessible alternatives for individual investors. REITs offer exposure to commercial and residential real estate through publicly traded or private means, providing liquidity and dividend-based income. Similarly, infrastructure funds allow investors to partake in a diversified portfolio of infrastructure assets, spreading out risk and capitalizing on the steady demand for essential services. So there you have it, friends, a guide to making your investment portfolio recession resilient. Remember, the goal during a recession isn't just to survive, it's to thrive. With the right strategies, you can protect and even grow your investments during economic downturns as value migrates from growth to defensives. If you learned something valuable, then say it by hitting the like button, share with friends and family, and subscribe for more insightful finance strategies. Drop your questions or topics you'd like us to cover next in the comments below. Until next time, stay smart, stay safe, and happy investing.